Understanding the $86 billion bonanza, the market isn't just moving, it's roaring. Wall Street is buzzing over a massive $86 billion buying spree. This isn't a small rally, it's one of the biggest, fastest floods of cash we've ever seen, driven by the big players with deep pockets and lightning-fast computers. These systematic hedge funds don't care about company vision or earnings, they care about momentum, and right now, the trend is screaming up. We're in the age of algorithmic warfare, where fortunes are made or lost in microseconds. Over the next few minutes, I'll guide you through this hedge fund frenzy, how these mysterious funds work, why peace talks matter, and what it means for you. We'll connect the dots between global headlines and your investments. Is this a healthy bull market or a house of cards built on algorithms and hope? Stick with me. The answer could impact your financial future. Let's break it down piece by piece. Booyah! Alright, let's get down to brass tacks. Hedge funds are the special forces of investing, private pools for the ultra-wealthy and big institutions. Unlike mutual funds, they use aggressive, complex strategies, betting on stocks going up or down. Their goal: make money in any market, up, down, or sideways, by hedging their bets. They use leverage to amplify gains and losses, managed by some of the sharpest minds on Wall Street. When they're right, returns are huge. When wrong, the fallout can be catastrophic. There are thousands of hedge funds, each with unique strategies. Some focus on value, others on global events. But today's headline makers are systematic funds, letting computers run the show. These are the players behind the $86 billion surge. Understanding them is key to this whole story. Let's dive in. Now, let's dive deeper into the belly of the beast. Systematic funds operate on pre-programmed rules, no emotion, just data. Their computers analyze market info, looking for trends. When the system says buy, they buy. When it says sell, they sell. Within this world, commodity trading advisors, CTAs, are the ultimate trend followers. They trade everything: stocks, bonds, currencies, riding trends up or down. Think of them as surfers. They don't create the wave, they just ride it as long as it lasts. Their buying can push markets higher, creating a feedback loop. More buying begets more buying, but it works in reverse too. When the trend breaks, they sell, amplifying downturns. CTAs are momentum amplifiers. When they move, the world watches. Their discipline and speed can turn a small rally into a stampede, or a dip into a crash. This is the engine behind today's market fireworks. No predictions, just relentless reaction to the trend. That's the power and the risk. So, let's get to the main event. In just 5 trading days, CTAs unleashed $86 billion into global stocks, more than some countries' economies. The speed is breathtaking, one of the top 5 fastest buying sprees ever according to Goldman Sachs. Why now? Their algorithms saw the perfect storm. After a shaky period, stocks started climbing, triggering a positive trend. As they bought, prices rose, confirming the trend and triggering even more buying, a powerful feedback loop. This wasn't a cautious move, it was a full-on cannonball, flipping from short to all-in long. It's a massive vote of confidence in market momentum, not any single company. And they might not be done. Another $70 billion could pour in if conditions stay favorable. This river of money can lift the entire market, explaining why stocks hover near record highs. When this much cash moves in one direction, it's nearly unstoppable. The bulls are running wild. And the stampede isn't over yet. The models are convinced. This trend has legs. But how long will it last? What lit the fuse on this $86 billion spree? Headlines about possible peace talks in the Middle East. For months, conflict created uncertainty and threatened oil prices, poison for stocks. But then, optimism grew. Reports of negotiations and a push for ceasefire. A potential resolution would stabilize oil, reduce tension, and clear the path for global trade. This news changed the market mood from fear to greed. CTAs don't read headlines, but they react to the effects: rising prices, falling volatility. Their models saw textbook signals for a new, positive trend. The why doesn't matter to the machines, the what does. Hope sparked initial buying, which started the trend. Then the machines took over, amplifying it exponentially. Computers don't hope for peace, but they profit from the market's reaction to it. In our interconnected world, a diplomatic breakthrough can unleash a tidal wave of digital money. That's how hope moves trillions, even if it starts with just a headline. The machines ride the wave, wherever it leads. Is this $86 billion binge unique? Not quite. We've seen similar surges before. When CTA signals align, they move markets fast. August 2024, a positive data point flipped the trend, and CTAs flooded in, pushing stocks higher for weeks. November 2023, inflation cooled. The Fed paused rate hikes, and CTAs reversed from short to long, fueling a year-end rally. September 2019, hope for a US-China trade deal triggered a wave of buying, propelling markets to new highs. The pattern turned uncertainty, a positive catalyst, then a massive algorithm-driven surge. CTAs can extend and accelerate rallies, but their buying isn't permanent. They ride the wave up, but jump off, and even sell when the trend reverses. Their presence makes markets faster and more volatile. They're fair weather friends. Enjoy the ride, but stay alert. So, why should Main Street care about hedge funds' billions? When $86 billion floods the market, it lifts all boats, including your 401k or IRA. Index funds benefit directly from this buying frenzy, pushing up account balances and market highs. This creates positive sentiment, encouraging more investors to jump in. But remember, this is hot, fickle money. The same algorithms that buy fast can sell even faster if the trend breaks. The rally is powerful but not always stable. It's built on momentum, not fundamentals. The force that amplifies gains can also amplify losses. Don't try to outsmart the machines. Stick to your long-term plan. Diversify, review your holdings, and be prepared for volatility. Enjoy the ride, but don't get complacent. Let's zoom out. What does this algorithm-driven money flow mean for market stability? On one hand, systematic funds provide liquidity and efficiency, reacting quickly to new information. But there's a dark side: crowded trades. When all CTAs pile into the same trend, stability becomes fragile. If the trend reverses, say peace talks collapse or bad news hits, algorithms will all sell at once. Hundreds of billions rushing for the exit can trigger a flash crash. This herding behavior is a major source of systemic risk. The same forces that create smooth rallies can cause sudden, violent drops. Regulators know the risks, but managing them is tough. The market is now prone to sharp, momentum-driven moves, up and down. Volatility is the new normal. We've pulled back the curtain on hedge funds and CTAs and seen how their algorithms poured $86 billion into stocks. Why does this matter to everyone, even those without stocks? The stock market drives confidence. The wealth effect makes people feel richer, so they spend more, fueling the economy. A rising market can lead to real job creation and growth on Main Street, but sudden crashes can damage confidence, slow hiring, and hurt pension funds. The financial system is the economy's lifeblood. If it's shocked, everyone feels it. That's why regulators watch these moves closely. This story is a perfect example of our high-speed, interconnected economy. Understanding these forces is essential for building wealth and navigating the future. Big money moves aren't just numbers, they shape our savings, our confidence, and our economy. Know the game to win the game. Booyah!